I think a lot of people get scared or don't pull the trigger. It's really up here. It's the mindset piece. If you're somebody that wants to get in, I don't care what space, hotels, multifamily, short-term rentals, be committed, put a goal in place, and execute. You can do it. I promise you can.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms.
All right, welcome everyone to another episode of Spur Equity's Spur Your Wealth podcast. We are your host, Budham Singh and Rav Singh of Spur Equity. We are, on our Spur the Wealth podcast, we aim to bring successful investors and experts on our podcast to share their stories and secrets into investing so we can all stand to benefit from their experience. So Rav and I are part of a mastermind group where we're really big proponents of joining masterminds and actually learning from others. And so we're part of this mastermind called Raise Masters, headed by Hunter Thompson. So we have the fortunate experience of meeting other Raise Master, other people in this mastermind that are, again, experts in their field. There's over 400 members of this mastermind. So we've joined this mastermind and really found really high caliber people as part of this mastermind, and we're learning from them. And so one of the benefits that we have is, we get to interview them. We get to bring them on our podcast. We get to, engage with them. So today we're in for a treat. We have with us on our show our featured guest and fellow Raise Master, Justin Mosley. A little bit of background on Justin. Justin is a United States Naval veteran. He has an extensive background in economics, in finance, and real estate. He's established Leicestermore Capital, his firm, which is committed to guiding fellow military veterans towards financial independence via real estate investments. And his niche focus is mitigating inefficiencies in short-term rental market, and has led to an impressive portfolio of properties all across South Florida. So we're really excited to have Justin here. Justin, welcome to the Spur Your Wealth podcast. So happy to have you here. Really looking forward to the value that you're going to be added to our listeners today, because a lot of our listeners are very interested in the short-term rental market. So I think you're gonna really engage with a lot of people here. So welcome.
Awesome. Thanks for having me on. And we'll see. I'm always happy to spread the good gospel of short-term rental space.
Excellent. Looking forward to it. So, as we get started, I want to, I gave a little bit of background, but I think I didn't do justice to that. So I want to give you an opportunity to tell our listeners a little bit about yourself, your background, and how you got into the real estate industry and launched your company.
No, I think you did a great job, but I'll go a little deeper. So I was a Navy guy, fortunate enough to really travel around the world. So from a very young age, I was stationed initially in Norfolk, Virginia, and then had the really benefit of doing a world cruise all the way to Yokosuka, Japan. So in that, before I was 23, I'd hit, Brazil, Chile, so South America, Australia, Singapore, and like the list goes on and on. And, once we finally settled into Japan, I was pretty much forward deployed every 2 months out, right? So it was a really, really eye-opening experience, one that really shaped me. I would even say more than my educational background. So when that time kind of came to an end, like everyone else, you're told to go to school, go to grad school, and that's the way you're going to kind of make it and stuff. And, I did those things, falling for the matrix trick, went to undergrad in Florida and fell in love with it. And then ended up going to graduate school in England, where I studied financial economics. And really it was there when I kind of realized, this is not what I want to do, right? Like I think, working for someone, just being plugged along in kind of corporate America, it was not going to be my path. And I realized too, just speaking with a lot of the veterans I know that were currently in or were active duty or out, I feel like we develop a lot of skill sets that really translate well into not only entrepreneurship but in real estate, and that really became my focus moving on. So While I did then jump into the corporate world, my whole time, my wheels were turning on like, how can I create a business that really allows me to increase my net worth and cash flow, but also do things that I love and I'm passionate about.
How old were you when you had that realization? You said that you still entered the corporate world, but you always think. But when
Yeah,
did you
yeah.
have that aha moment that this is not for me?
Yeah, not early enough. So I was in for a while. I was in for 6 years. Then, by the time I got through all that, it was probably in my late 20s, early 30s is
Wow,
really when it
still
clicked for
early,
me.
man. That's
So
great.
yeah. Right. It's all about perspective, right? And it was great because I just really talked about on one of the last podcasts, even on social media. It's how for a lot of military guys, you feel like you're behind the eight ball, even when that's not true. So when I got out of the
Yeah.
military, I was probably 24, 25, and sitting in the classroom with 18-year-olds and feeling like, God, I wish I could get out of here. But now looking back as a 38-year-old, I realized like I was just a kid. Like, but it's all about perspective, right?
Absolutely, absolutely. Hey, so I appreciate you also coming on the show and also for your service, by the
Appreciate it.
way. Tell us a little bit about then, when that mindset was sort of changing for you, what was the next step? How did that lead to where you are today or what you were doing
Yeah,
yesterday?
for sure. So it became self-education and investment in myself. And I
Excellent.
tell guys, especially younger guys, all the time. I mean, I got a master's degree in financial economics, and not one time did I take a real estate course the whole time, right? So really,
Mm.
it was up to me to like really figure out like how can I make this work. And then I went through YouTube education, like a lot of young guys and even older
Yeah.
guys out there now, right? Podcasts, reading books, a lot of YouTube. And really, what direction that sent me into was actually commercial syndications for a multifamily. And that was kind of my first step into a kind of real estate world.
Got it. So you started more as looking at, hey, let me invest my capital versus let me open up a fund. I mean, how did
Yeah,
that
so
happen?
no, I wanted to kind of really be in charge and figure out like how it all works. So my first foray into real estate was being the tiniest piece of a GP portion on a multifamily deal, and I figured it out like through listening to podcasts. And I'm a really big guy or proponent of like taking what other people have learned and trying to implement them in my own life. And one of the themes I heard throughout, all the guys were doing really well is, I wish I could would have went bigger faster. And that was kind of what I took to heart. So I scrambled and networked and said, hey, look, I'll do anything, and really try to find a niche of where I could add some value. And that led into being a really small portion of the GP sliver of my first kind of multi syndication deal. And it was great. I still love multifamily. I think it's an awesome thing. But I think that was when I really kind of learned that a lot of the big money is on maybe a little bit on the front end, but truly on the back end, like the exit. That's when you either refinance or you sell. And I was just greedy, and I wanted it faster. So I was like, what can I do to like actually generate some cash flow in the meantime, and not be waiting to get in all these different syndication deals and then get that huge windfall on the back end. So
Yeah,
that led me into the short-term rental space.
that's great. So,
Got it.
I want to touch on something here that our listeners
Yeah.
I think will value. Right? You said you invested in yourself in your education.
Hmm.
Obviously, YouTube education and kind of networking and meetups and things like that. And I think that's sometimes we underestimate that. The amount of resources that are available to us, one for free, right, to be able to learn something, and then secondly, how many people there are, how many resources there are out there that are again willing to spend the time to actually guide you and teach you what they did, and not even what they did, but like to your point, like, hey, here's what I did, but you can jump 3 steps ahead of what I jump 3 steps. Don't do the first 3 steps I did. Go to step 4, right? Because that's more advantageous. Because I learned a lot, and so the fact that we have so many people that are willing to give you guidance, and that's again one of the reasons that I love these masterminds, is because you go to these masterminds and you find somebody that is 3 years ahead of you, 4 years ahead of you in where you want to be. and basically go to them and say, hey, how'd you get there? And then, they'll lay out the steps and maybe even eliminate some of the steps that they took. So I love that. And I think our listeners can get some guidance like from podcasts like this and other stuff out there that, hey, if you want to start, don't have to do it in a vacuum. There's plenty of avenues on how to do this. And there's no one right way. And that's the thing about real estate is there's dozens of ways to make money in real estate, right? You mentioned syndications. We're going to talk about short-term rentals. We're going to talk about, kind of crowdfunding or whatever. There's so many different ways to do it that, you really have to find what speaks to you, right? And kind of follow that path.
For sure. And you hit the nail right on the head, especially with masterminds, right? It's like, getting around people that are doing what you want to do and figuring that out. And I'm such a believer of, paying into the mastermind, right? Like I know my first one that I paid into, I paid upwards of $25,000. And that was into a multifamily mastermind group that I really didn't grow in multifamily, but the network, the confidence, the structure was foundational to me kind of going into this other space. So people could
stepping stone.
Yeah. People can a lot of time poo-poo like, oh man, I don't want to pay for X, Y, and Z. But you have to think about it as investing in yourself that will help you get there so much faster than trying to do it on your own.
I agree. I mean, this is it, everything kind of leads to wherever you are today, right? And so, as a stepping stone to your education, you invested in yourself. So that's amazing. Tell us a little bit about your company. I mean, I see in the background there's a logo there. What does that mean? How did you get there? How did you start that fund?
So, do you mean what does the company name mean? It's always an interesting one, right? So.
Right.
Yeah. So I tell people all the time, it's either the dumbest thing I've ever done or the most brilliant thing. So there is a little bit backstory behind it. So my wife is English, and so a part of the reason why I went to grad school in England, being a dumb American, thinking when we met, and she had to go back. I'm like, oh, I could just go over there, no big deal, and realized quickly they were like, no, that's not how it works. So. I ended up going over to England and getting a visa to go to grad school. One of the reasons why I went. And actually, where she's from is a place called Leicestershire. So it's in the Midlands. I went to the University of Loughborough, which is there. And when I came up with the company name, it was started kind of as a family thing. So it took where I'm from, Baltimore, and where she's from, Leicestershire, and I put it together.
Excellent. I love that.
And there you go.
Combined it together.
Yeah. And one thing is, if you Google
beautiful.
it, even close to it, I'm the only person that comes up. But not a single person has ever been able to pronounce it the first time. You might be the first one to ever. I don't know if you had notes prior to this, but no one can ever pronounce it.
I lived in England. Yeah, I lived in England
so
also.
You knew.
So yeah, for like a year and a half, I was out there for work as well. My wife and I. So we've traveled all around England. So yeah, Leicester, right? So
yeah, exactly. Yeah.
That's amazing.
But yes, so awesome. What we do is, so we have a variety of different things. So we, do some short-term rental syndications. We're up and starting a fund with some really heavy-hitter partners, which I'm really excited about. So I can't go into depth about it, but and then we also partner with people that want to get into this space. So we are really unique investments, but we really focus in on the short-term rental space because we love it and we think we have some competitive advantages there in how we do things.
Tell us about that. I mean, let's get into the details about the business plan. What does that mean? A lot of our investors that invest with us, they understand investing in general. They understand multifamily, but they also maybe have one or two of their own short-term rentals, Airbnb or whatnot. So they're doing that on their own. What's the difference between that versus a fund versus investing in a fund? Let's kind of dig into it a little bit.
Yeah, for sure. More. And I think you actually hit the nail right on the head, right? So the majority of short-term rental operators, I still think the statistic is somewhere in the 85% range, owns less than 3 properties and are not truly operating as a business, right? So you have a space where it has not been institutionalized yet. And for people who are really heavy, or I guess they're ear to the street in real estate, to me, this is like what it was 10, 15 years ago for single family homes. Before American Homes for Rent and all this institutional capital came in and started like buying it up, like I think in the next 10 years, for operators that are really growing a portfolio of short-term rental products that operate efficiently, I think this will be its own asset class to where they're buying these in bulk. There's been whispers of Blackstone looking to buy a bunch as its own asset class, but there really isn't a consolidation in the space yet. And I think that's truly where the operational efficiencies come in and also where the opportunity comes in is why I love the space.
Yeah, I mean, I think, I have a very, very similar kind of approach to this. Rav and I have been talking about this too. So I owned a single family home in Florida, actually, in the Disney area way back when, before Airbnb was a thing. But as you know, in the Florida market, especially in the Disney market in Kissimmee, short-term rental was, specifically done. There's tons of companies that are managing property in the Kissimmee and Disney area way back in the early 2000s and even before that. And so that's where our first venture was, for my wife and I. But you're absolutely right. The inefficiencies of having one property or two properties, and then it being far enough away from our home, we had to hire property management and hire all this other stuff that it really ate into all of our profits. Right? It just didn't net anything for us in terms of cash flow. But when I look at and so the flip side to that is Rav and I have looked at institutionalizing an STR, like doing an STR fund and actually going after something that's very, very strategic in nature, where your acquisitions are specific, right? And there's specific criteria on acquisitions, what kind of market you want to play in, not getting, maybe, in a market that is heavily saturated with 2 to 3 bedrooms, maybe going for a 6-bedroom, right? Or something like that. Something that differentiates you. And then you have these efficiencies on top of that. Then you're talking about, exponential, kind of growth in that cash flow, where 1 or 2, 3 properties may not even generate some cash flow. Now you're talking about something that, you're using a team of people, you're using same management, you're using, efficiencies, economies of scale to actually drive that. You could squeeze a whole lot more, right, out of that from an institutional level. So that's what gets me excited about short-term rental is exactly what you're talking about.
Oh yeah, absolutely. And that's kind of how we look at it. And now we're in a point where you can really to start diving into operational inefficiencies like dynamic pricing and really when you're talking about the syndication model, where you can almost cherry pick where the best properties are operating or being located without having to consolidate in one area. And that's one of the strategies we deploy. We don't necessarily need to buy 10, 20, 30 properties in one market to get economies of scale. We can cherry pick the best properties throughout the country,
Right.
and really drive some great returns for our investors.
Absolutely. How are you looking at it from a regulation standpoint? I mean, a lot of cities, a lot of states, right? I mean, have different rules and regulations, and then homeowners association comes into play. So, how what's that model that looks like for you? And then regarding funding, from a lending standpoint, how are you looking at that? Are lenders specific to SDR that are there that like the space? Kind of give us an idea, and to us and also our investors on that
Yeah,
side.
for sure. So when we first talk about regulation, I like regulation. I think number one, it legitimizes the space. I think a lot of investors get scared by it. The reality is there is a little bit of unknown. There's a lot of risk because there really isn't any, federal regulation or even state regulation, right? It's all down to municipalities, cities, and stuff. And I think that's where kind of the research piece comes in and really being abreast of what's going on in your area. So we try to stay in markets that are a bit more short-term rental friendly, or we think they will be in the future. But also too, like we like going into markets where we think they're going to implement caps, right? A part of our strategy is, if they're going to put 250 short-term rental caps in an area, it makes sense for us to go in and buy 3, 4, 5, 6 properties, right? But then it's a supply and demand game. And this is when you're talking about the economics, right? Demand's going to continue to increase, supply stays steady. So that's upward pressure on ADRs, occupancies. And it's funny because stuff like that, people don't even think about it and they run away, where it's like, oh no, this is opportunity. And really, I kind of take a lot of what Warren Buffett says, and people love to scream the stuff that he says, but when it's time to actually execute, everybody gets scared and they don't want to play anymore. But this is where we want to play, right? So that's how we look at it. And I guess,
I love.
yeah. So what's the next question? Sorry.
I was just going to say, I love what you said about regulations. That you like regulations, because I feel like you're absolutely right. Like people get scared, when you're thinking about, oh, there's regulations around a certain thing. But what regulations mean for me, if they're already in place, is there's predictability, right?
Yep.
It's going to be really difficult and hard to actually change regulations that are there versus if there's no regulations and then something comes in, right? I mean, you could obviously be grandfathered in if something comes in after the fact, but if there are regulations there, you know where they're headed. There's like a 5-year, 6-year, 10-year horizon on where those regulations are going. So there's a little bit of predictability or a lot of predictability in that in those markets where there is regulation. So yeah, I like what you said there.
Yeah, and it could.
Yeah.
Yeah, go ahead, Raf.
Justin, I was going to say, thanks for answering that question. My second question was leading towards the lending side
Yeah.
of it. How are you lending, getting lending on this, or is it all cash, on your side? Just give us a little idea on
Yeah, so
that.
we have a variety of strategies, and just kind of depends on the almost it's property specific a lot of times. But we like
Sure.
lenders that believe in the STR space, right? So they don't necessarily have to have a product for the STR. For in general, right? So before COVID, there actually were some lenders that were lending on almost pro forma, right? Like AirDNA data and stuff. We'd
Hmm.
actually stay away from that. Our kind of thesis is if it doesn't work as a long term rental, so worst case scenario, something does happen, we need to know that we can at least break even or have a little bit of cash flow in. So I don't necessarily need to go to a lender that's going to underwrite a property to pro forma. So really, just the standard for us is do they believe in what we're doing and they believe in the space, and those are the lenders that we want to work with.
So
Yeah, that's
let's
good.
talk about challenges, right? So one of the, I mean, obviously this is um, a different market today than it was a year ago, 2 years ago, or through COVID. Through COVID, I mean, we made, the Airbnb space, short-term rental space, actually, clobbered, right? I mean, I think we definitely see that, right? A lot of
Hmm.
domestic travel was happening, a lot of driving was happening, so. It's a little different now, right? One, from a lending standpoint, as Rav pointed out, that cash flow and profits are stretched a little bit just because the
Hmm.
interest rates that are there, but you can still make a profit, obviously. So that's one challenge. Secondly, we've heard, especially in the last 6 months, 9 months, that short-term rental occupancy is actually headed down, right? So from an Airbnb standpoint, STR standpoint, how are you in your current portfolio? How are you addressing? And then, this is not across the board, right? This is kind of an average,
Hmm.
right? But in your specific properties, how are you addressing potential hits to occupancy? How are you getting your properties to not have a hit in occupancy as drastic as sort of the national average? What are you guys doing?
Yeah, yeah, absolutely. And really, I think this goes back to really trying to institutionalize the space. So just to kind of address what's going on nationally, I think that is little bit of gypsy magic, right? People love to they'll go quote, what's going on in Phoenix or some of these other markets that were absolutely out of control during COVID that have a bit come back to earth and say, oh, wow, Airbnb's taking a hit. They're down 50%. When the reality is, if you're a good operator, you weren't projecting those absolutely unrealistic ADRs or even occupancies, right? So the way we kind of underwrote our properties, yeah, we definitely boosted revenue and things like that during COVID, but almost all of our properties are performing just the way we anticipated them to, like to operate, which is smooth sailing, right? I think the challenge moving forward is going much more all in on the experience piece because this is a review based business. I mean, it's hospitality as much as it is real estate. So providing almost those concierge type services that you would get in a hotel, but you're getting in a single family home is kind of the way we look at it. Creating those experiences in the backyards, like what things can we do, like bring in popcorn trailers or like little tables where in movie rooms and things like that, to where we're getting that high value customer that's willing to pay that premium, that really just helps out overall. So our kind of thoughts are just like how can we increase our operations, how can we increase experience, which will then increase our visibility on these platforms because our reviews remain high. So we're very optimistic moving forward. I think if you can really run your property well, you're not really worried what's going on in the larger economy. You're worried about like what can you do to grow now, and especially when you talk about the interest rate thing. Again, and believe me, we try to mitigate risk, but if you can operate now with 7, 8% interest rates, Imagine what's going to happen when these rates drop back down, right? And that's what we think. In the next 2 years, when elections come around, magically rates will start decreasing for whatever reason and stuff, right? And we'll be able to recoup a lot of the equity that's in these properties. So, we're very bullish on this market, especially if you're a good operator.
That's really a good perspective in regards to the fact that you're right now underwriting deals at a market where you're pretty much your debt's at an all-time high, right? And so imagine what's going to happen in the next couple of years when that starts going down, or what the returns might look like at that point. So that's a valid point. I hear a lot of people just talking about hospitality hotels versus SDR, and there is, of course, there's pros and cons to it. What I like about the SDR part is that you could have different groups have different sort of experiences. I see a lot of the younger generation. I know a lot of my folks that are younger are wanting to go into the SDR world just because they can create that experience themselves, or they're looking for certain things in the backyard versus inside the house itself, or accommodating bigger groups, whatever that case might be. I think there's a lot of pros and cons. On the SDR side, when you are purchasing a property, looking at buying multiple properties, what about different portals? Are you loyal to one versus the other, or do these go in lots of different portals, and your customers are coming in from different areas? Kind of let us know regarding the marketing and the business side on the business
Yeah,
itself.
100%. So we definitely are not loyal to any particular portal. We understand there's a lot of risk, right? So we don't want to just be on Airbnb and that's it, because anything can
Yeah.
happen, right? So we are very diligent about being distributed across everything: homestays, VRBO. Google has a platform now that they're trying to grow. We haven't focused as much on direct bookings. I think there's a certain threshold that you need to reach as far as like the amount of properties you have to make that advantageous to really invest money in. So we're
Yeah.
definitely not there yet. But in the future, that's something we're looking at to try to create. But I think there are different kind of operators. There are people out there that are consolidating, that want to create a brand. And there are people out there that are consolidating to really give value to their investors. And we definitely lean more on that side. It's a game of like, how can we grow, but also give the most value to our investors without trying to create that brand as well. So, I think that is truly where our focus is. So, we try to make sure that we're spread evenly across all those distribution channels.
Right, right. And are you, just curious, are your returns pretty much similar to what you were doing on the multifamily side, or there's this side's better than the other side? I mean, I know you have a preference in regards to what you're doing on the SDR side right
hmm
now, but me, if I was the investor, I wanted to invest with you or invest with Perm doing, let's say, multifamily versus SDR. Am I looking at similar type of
I would
returns?
say you're looking at slightly better returns, and especially even in our
Oh,
in
okay.
conservative underwriting, right? So you got to equate
Right.
for that cash flow is significantly higher in the short term, especially in the syndication space. When you exit, that you may take a hit there, right? Because you're not necessarily able to increase the value based off NOI like you can in multifamily. But again, right, interest rates come down, upward pressure on houses go up. We don't know. In the future, it could be just as the same. Or what I also think will happen, you have private equity or investor groups start saying, hey, maybe it doesn't make sense to evaluate this property on the appraisal basis because I have two properties side by side. Let's say they're identical at 500K. One's bringing in what, $440,000 in just rent, right? The other one's bringing in 150, 200K. Does it really make a whole lot of sense to value it the
Yeah.
same way? Right now we do, but in
Yeah.
the future that
Right.
might not be the case. So again, there's a lot of upside there.
So talk about like that exit, right? I mean, you mentioned
Mhm.
earlier on that Blackstone and others are looking at this kind of attractive model. So from an exit standpoint, it sounds like there's a lot of flexibility, right? Like
Yep.
you could exit a particular market that may not be doing well, or some properties that are not doing well, and they're like, hey, let's exit those and focus that capital on something that is going to be growing, and then ultimately, if you finished out a business plan, or you've taken it to where it needs to go, and now, hey, let's sell this whole thing as a portfolio, as an
Yep.
STR portfolio, right? So there's that flexibility. How have you modeled your exit on the portfolio? Are you looking at both?
Yeah, we like to give ourselves a lot of flexibility and opportunity to really pivot depending on what's going on in the market, what we're seeing happening. We don't really want to be pigeonholed into a space where we have to make a decision. So even in, some of the multifamily guys, even in our underwriting with syndications, like we like a lot of 1 year extensions to say, hey, this might not be the right time to sell, or this might not be the right strategy at this moment. So that's kind of where we're at. So we like the flexibility, and we like the opportunity even for single assets to say, hey, maybe we just sell this back to the retail market, and there might be value there that makes sense, right? So there's a lot. So you hit the nail right in the head, right? There's a lot of different areas that we can exit, or maybe even just a refi on a portfolio and get a portfolio loan that we could pull a lot of equity out, give that back to our
that's
investors, and we
interesting.
keep rolling, right? So we have a lot of flexibility on this end.
Now, are you seeing
That
are you
yeah.
seeing lenders being more, because again, right, and when you're talking about acquisitions, right,
Mm-hmm.
it's like property, each property at a time, essentially, right? The lenders are evaluating it, but on a as you said, like refinance or appraisal of a portfolio, or when you're looking to exit, are you seeing a lot more lenders being open to the idea of like a portfolio loan? Have you done an acquisition of a portfolio where they evaluated it, that portfolio together versus individual properties? And, talk a little bit about that. I mean, I think I see the future
Yep.
potentially more lenders being open to that, but I think, again, risk tolerance and things like that, they may not be all there, right, across the board. So talk to me a little bit about that and what you're seeing.
Yeah, 100%. I think there are a lot of lenders that are still kind of like a lot of capital, almost effectively on the sidelines at the moment, right? They're very hesitant on what's happening in the market.
Yeah.
Fortunately, we are have relationships with some lenders that actually do perform in that space, especially on the portfolio side. And if they're comfortable with you and your operations and your history, I mean, they're very comfortable giving aggregation lines, things that really help you accelerate if they feel like you're able to kind of mitigate risk and they really see what you've done from a historical standpoint. So, I can't speak to everybody, but it's just, you need to build those relationships with lenders to make sure they're comfortable about what you're doing. Because not every lender is equal and they all look at things very differently, as you guys know.
So Justin, talk to us a little bit about partnerships, right? So we've been successful in our, in our business through some of the partnerships that have happened. You mentioned yourself that, the first foray into real estate, it was, you got a little bit of a GP sliver, with presumably a bigger partner that that had something in working that allowed you to kind of enter there. So one, the kind of importance of partnership, the kind of importance of pulling things together and doing something. And then secondly, a sort of a related note, right? From an advice standpoint of somebody that is passionate about real estate or passionate about, hey, I want to actually try this myself. I want to do STR. And they're looking to, let's say their idea is, hey, I'm going to go buy a single unit versus, investing in a fund that is doing what you're doing. What kind of advice would you give, again, in that same light, right? Like you can do more, I guess, in a partnership, versus alone. Not to discourage anybody, but I would say, if somebody approached you and said, hey, I'm really looking to do something very similar and I want to get into this SDR space, what kind of advice would you give them, as we talked about earlier, that could potentially accelerate their path, right, to kind of success, right?
Absolutely. So I'll answer the first question first. So I truly, truly value partnerships. I think one of the cool parts about real estate in general is you effectively can work with who you want to, right? So for me, it's always about finding people that have very similar values, and most importantly, maybe even more important than values, which that's incredibly important to me, is work ethic. Like I'm a guy that likes to go. I definitely like to think I like to mitigate risk, but I think almost anything can be overcome by taking massive, big enough action, right? Like I get up every day at 4:30, I work out. I don't care if I feel like it or not. I do it, and I want to work with people that I don't care how you're feeling. If there's something that we need to do, you're going to be willing to do it. Almost a military kind of mentality, right? But that's just me. And those are the people that I get along with. Discipline. Those are people that I like to go to war with, and business can be war sometimes. And it requires a level of dedication that a lot of times a lot of people aren't willing to put in, right? You guys understand that in entrepreneurship. And then to touch on your next question, again, it goes back to mentorships, mastermind groups. A big part of what is important to me and why I created the short-term rental millionaires blueprint was creating a space for people that want to get into the space that maybe doesn't have 50, 100 grand burning a hole in their pocket that they're looking to deploy and make work for them, and they just want to do it themselves. Maybe they do, or maybe they just want to, grow a portfolio themselves. So I created a community of people that truly are go-getters that want to get after it. And the difference that I think I do versus maybe some other people is I really focus in on the automations of the space, right? So you spoke about you had a property in Orlando. You know that a property manager is going to charge anywhere from 25 to 30% of your net revenue coming in. That makes it really hard to take full advantage of the benefit of having a short-term rental property. And in that program, it's a module coaching program. It really focuses in on how can you utilize VAs very cheaply? How can you create systems that constantly make sure that your guests are good and really put you in the best position possible to really operate efficiently in that space. So again, if you're really curious and really hungry to get into the space, whether you want to go all in or maybe you have a W-2 job and you want to do this on the side, the short-term rental millionaires blueprint, I think is something you should definitely check out. And that goes to your listeners. So.
I was going to say one thing. I loved your mindset where you talked about your discipline aspect of what you were doing previously and how you're bringing that to your to your business now, and therefore to your investors and to your community. So I think that's really important, because while we may all focus on capital and money and success, but we also need to focus on other aspects of life, right? In terms of that. And so I love the fact that you're bringing that to the table, and that's something that you were very strong in, and you were believing in that in your previous career, which is in the military, on the armed forces, and now you're bringing that onto your business side of it. So love that. I think that's great. Any final thoughts to our listeners, and any advice to our listeners, regarding just life in general, regarding business?
I think what I would say, and I always like to kind of leave on this note, that I think in real estate, this isn't hard at all. And I think you guys really understand that. I think a lot of people get scared or don't pull the trigger. It's really up here. It's the mindset piece. And I think once you really get across that and realize you can do it, you don't need to think that you can take over the world, but you need to have disciplines every day in place that will give you the confidence that over time, once that kind of grows exponentially, you will realize that you can accomplish anything you want to do. So really, I kind of just want to leave it there that, if you're somebody that wants to get in, I don't care what space, hotels, multifamily, short-term rentals, be committed, put a goal in place, and execute. You can do it. I promise you can.
That's great. I love, I had this, we had a guest on and we were talking about some of the same things. We're very action oriented also, right? I mean, educate yourself, but it's up to you to take action, right? Kind of thing. So I like this. Done is better than perfect, right? So if you're sitting back and making sure everything, all the stars are aligned before you take a step forward, you're just going to be sitting there and waiting. Right. So I love that. Done is better than perfect. That step in. Yeah, you can self-correct. You can go in. You can make a mistake. If I look at my, our path, I say to these people, I say to my kids all the time, I wish I failed faster. Right. Yeah, I failed along the way, but I wish I failed faster so that I took a step and I failed and I moved on from that rather than sitting in the sidelines. So I agree with that 100%. So Justin, as we wrap up, why don't you tell our listeners if they wanted to get in touch with you, look at the STR multi-million blueprint, or follow you on social media or whatever. What's the best way to connect with you directly?
Yeah, really any of the social media. So I went from anti-social media to I'm on everything from Twitter, TikTok, LinkedIn, Facebook, Instagram. So it's always Justin C. Mosley _ LCM. You can reach out to me directly. I will reach back out. And we have a bunch of Facebook groups on Facebook. So for the Airbnb Millionaire, it's completely free. If you want to go in, check it out. My wife and I give a masterclass that's completely free on how we got started. And that's just a great place to start and kind of give you the motivation and drive that you can do it yourself. So that's it.
That's great. Well, Justin, I want to thank you for sharing your story with us, with our listeners. Again, truly inspiring. What you've been able to accomplish, and wish you loads of success. Thank you for being on. For our listeners, thank you all for tuning in as well to this episode of Spur Your Wealth podcast. Again, we are your hosts, Param Singh and Rav Singh from Spur Equity. Remember, your journey to financial freedom begins with knowledge and action, where knowledge is power.
But action is superpower. So until next time, happy investing. Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at SpurEquity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@SpurEquity.com. Until next time, happy investing.